We're all champing at the bit, right? NVIDIA, we can't wait for the results. But there are other names, other tech names in the mix, too. In fact, Goldman put out a note to their clients over the weekend and say, hey, tech hardware makers, Dell, Marvell, Hewlett-Packard, NTAP, network appliances, software companies, they're all, sort of in the mix as well. Let's bring in Crestcat Capital partners, Octavio Costa. And Tavi, you wrote something I thought was really compelling. I'm glad you were able to come on today. That the defining feature of the coming market environment will be a profound divide between spenders and earners. Now, we just heard Zalewska saying that the spenders are benefiting huge. You say it's not about a marginal trend, but a structural reordering of capital flow. You put this chart out. Walk us through what this means, because your work is so really thoughtful, and we want to kind of get a feeling where we should be positioned.
Well, thanks for having me, Charles. I really appreciate that. And I think the idea here is that we're going to see a rotation probably of capital, tens of trillions of dollars in market cap, particularly in the tech companies. And they have major amounts in their balance sheets that could leverage. I think people are underestimating how much leverage they can take. I would suspect they can take up to 40 to 50% of their current balance sheet, which is sitting now at about $3 trillion. And that money is going to come into the earners. So this spenders versus earners, I want to focus on the earners. There's three categories of that I think is going to be very important to invest. Most likely energy, and then infrastructure, and the last one is going to be raw materials. I think raw materials is arguably even the most attractive one, given the fact that we've seen so many supply constraints in that industry, and it presents so much inefficiencies that I think it's a cold word for opportunity. So there's going to be a lot of things to be doing here in this market with this potential rotation and unleash of capital into other parts of the market that have been neglected for a long time.
All right, so now we've got your table here again. Energy, I think utilities represent that well. They're doing pretty well. Industrials are doing pretty well. Utilities under infrastructure. So energy you have separately. And materials, energy and materials still haven't done well. So you're saying, hey, this is the time to start looking and maybe being positioned for this.
Yes, I haven't been this bullish in energy for a very long time, and specifically oil and gas. But in general, I think natural gas is going to be the big answer for our energy supply for the AI and onshoring. But there's also going to be investments in solar panels. And then the infrastructure for that. If we're going to get natural gas to the whole country in a bigger way, we're going to need more pipelines and so forth. And so the infrastructure is going to come online in terms of the revamp of the grid that we have currently. It's going to be huge. And I think if you think about the raw material side, it's even more important. The steel producers, the iron ore producers, the copper, nickel, zinc, all these metals are going to also become incredibly relevant. I think the administration is right about pointing that out as being critical industries, and we're going to see more and more investments in that space. I'm sure you saw what happened with MP materials in the rare earth.
Yeah.
I think we're going to see more of that in other parts.
I laugh because I talked to my investing team, and they said we should be in it. And I said, let's find something else. And, of course, they were right. Hey, let's talk about the adoption, right? Because this is a table I saw floating around that showed in the 1800s, right? We talk about these different industrial revolutions. 6% CapEx as a percentage of GDP, U.S. GDP. Could we get that high? Could this AI story become that big of a component of our overall economy?
I may shock you, but I think we're going to see higher than that. And the main reason for that is because railroads and the internet were, in my view, a little bit different than what we're seeing now, actually very different. In regards to this arms race that we're seeing, in which I think the only time we've seen this is during war times. And so which country is going to get there first is, I think, it's a big question. And so they are going to be spending. The spenders are likely to spend a lot more than people are expecting. And so construction right now sits at around 7% of GDP. Back in the 60s and 70s was about double that amount. Right. I think we're going to see more than that. And I think that chart, maybe I would add other things. It's just looking at one side of that coin, the data centers. And what about that whole part of the infrastructure we're going to see? I mean, miners alone need trillions of dollars potentially. And so, you start adding that up, it's going to be pretty significant. Sorry.
No problem. We're running out of time. We've got less than 30 seconds, but I wanted to give you some props. Congratulations on your precious metal fund, the Crestcat Precious Metal Fund. You have absolutely crushed it since you've been out there. You've been talking about gold, though. You were talking about gold when no one thought it was popular. So I just wanted to give you some credit there and say thanks, man. Your work is fantastic. Thanks a lot.
It's very nice of you, Charles. Thank you very much, and let's keep going. Thank you
Let's
very
keep
much.
going. Why not? We love making money.